The Federal Reserve, often referred to as the U.S. Central Bank, has recently made a significant policy announcement that could reshape financial markets, signaling the end of what some have called the everything bubble. The term refers to the remarkable price increases across a wide range of assets in 2024, including cryptocurrencies, AI stocks, quantum computing stocks, and even real estate. These gains were largely driven by optimism that inflation was under control and that the Federal Reserve would continue cutting interest rates over the next several years. However, this outlook has now changed dramatically, with Chairman Jerome Powell and the Federal Open Market Committee revising their plans, causing immediate ripple effects across markets. Immediate market reactions. Some of the most speculative and high-growth areas of the market, such as cryptocurrencies and high-valuation stocks like Tesla, experienced sharp price drops following the announcement. The market's reaction was swift, signaling just how impactful the Federal Reserve's policy changes are. While interest rate cuts are typically associated with bullish market sentiment, the Fed's messaging about a reduced pace of future cuts and higher inflation expectations tempered that optimism. Investors were left re-evaluating their strategies in light of these revised projections. The Federal Reserve's mandate, a balancing act. The Federal Reserve operates under a dual mandate to maintain low unemployment and to keep inflation around 2%. Achieving these goals requires balancing often competing priorities. For example, policies designed to stimulate economic growth can reduce unemployment but often lead to higher inflation. Conversely, measures to control inflation typically involve slowing economic growth, which can increase unemployment. This balancing act is further complicated by the potential consequences of runaway inflation, which is widely regarded as more damaging to the economy than moderate increases in unemployment. Inflation that spirals out of control can erode the value of money, destabilize financial markets, and undermine economic confidence. The Fed's recent actions reflect its effort to prevent such a scenario while still supporting economic growth. In 2024, declining inflation allowed the Federal Reserve to shift its focus to unemployment, resulting in a series of interest rate cuts. However, with inflation beginning to accelerate again, the Fed is reassessing its priorities. Broader implications for investors. The Federal Reserve's decision to take a more restrictive stance reflects a growing concern about market exuberance. Asset price increases can contribute to inflation when investors use their gains to make additional purchases, further overheating the economy. By signaling fewer rate cuts and higher inflation expectations, the Fed is attempting to temper this enthusiasm. For investors, this shift serves as a cautionary tale. Speculative assets, particularly those with stretched valuations, are at greater risk under a more hawkish monetary policy. The adjustment in interest rate projections suggests that the cost of borrowing will remain elevated, which could dampen economic activity and corporate earnings, especially in high-growth sectors. A call to action. This policy shift underscores the importance of a cautious investment approach, particularly in volatile markets. It's a reminder that while high-risk, high-reward assets can offer significant upside, they are also vulnerable to macroeconomic changes. Investors should consider diversifying their portfolios and staying informed about economic trends. Before signing off, the importance of subscribing to the channel is emphasized. Subscribing not only supports the channel, but also provides viewers with the opportunity to request specific topics for future videos. This engagement helps the channel remain a valuable resource for investors navigating complex market dynamics. In summary, the Federal Reserve's latest announcement marks a turning point for financial markets, with significant implications for inflation, interest rates, and investor strategies. It's a reminder to remain vigilant, adapt to changing conditions, and approach speculative investments with caution.